What's up, everyone? It's Eric with Option Edge, and today I want to talk about how you can lessen your tax bill using options with a little tax loss harvest. All right, we're going to talk about how to harvest some taxes with some options, okay? And what I mean by that is basically how to incur a loss, so you can deduct that when it's time to file your taxes, okay? And one of the main things we're going to be talking about is what exactly is a wash sale. So let me explain. A wash sale occurs when an investor sells a property at a loss and within 30 days acquires substantially identical property. Okay, let's go into that, what that exactly means a little bit in more depth. So basically, if you sell your stock for a loss and then buy the same stock back within 30 days, this will be counted as a wash sale. This another way to incur a wash sale is to sell and then buy a call option in the same underlying stock. So you cannot deduct wash sales from your taxes. Okay, so wash sales are bad. You want to avoid them if you plan on having a taxable loss. Okay, so let's continue. So here's an example of a wash sale. So let's say I buy 100 shares of Apple on December 1st in 2020 for $100 a share. Okay, that stock drops to $80 a share. We sell on December 15th and we incur a $20,000 loss. We come right back on December 31st, only 16 days later, we buy the 100 shares back for the $80 a share. So this would actually be a wash sale even though we had a $2,000 loss, okay? Because we bought those shares back within that 30-day period. We bought it in about 15 or 16 days. So let's continue. So let's say we were just to buy the shares, sell them for a loss of $2,000, okay? And then we would repurchase them. On January 15th, okay? So that's giving us 30 plus days to allow the sale to be completely washed, so to speak. So we would be able to claim that $2,000 loss on our 2021 taxes. So let's talk about why we're here today, harvesting a loss with options. Okay, so let's say same scenario, we buy 100 shares of Apple, we sell that for a $2,000 loss, but then we come right back and sell an out of the money put. Okay, so there's a big distinction when it comes to that. The first slide, let's go back to the first slide. Substantially identical property. It's important that when you're selling a put that it's out of the money. Otherwise, an in the money put or a deep in the money put can be viewed by the IRS as a similar asset. Okay, so let's just put that out there. So it's got to be out of the money. So notice that 75 is lower than the current price right now. Let's say you sell that for $4, so you get a $4 credit. And the expiry is May 19th. And remember, we sold, in this example, we're selling the stock on April 15th. So that gives us 33 days till expiration. If the stock stays above the $75 strike, we receive the $4 credit. So if the stock explodes back to 100, we're going to miss out on those gains and we'll only have a $4 credit to keep. But if the stock drops to $70 at expiration, we're going to keep our credit, but we're going to get assigned those 100 shares of stock at $75 a share. Our net, basically the price that we'll pay overall, though, will be 71 because we're going to take the strike minus the credit received, 75 minus 4. So it's going to be like buying 100 shares of stock for $71. This would be a $1 loss if the stock drops to $70. Okay, so as long as this happens 30 days after selling the shares, we would avoid the wash sale. So by selling an out of the money put, you are, there's no guarantee you're going to get assigned the stock, but you're sort of still in it and you can still gain with that credit. Okay. So let's go into capital gains, okay? So the maximum amount of capital gains you can claim in a single year is only $3,000. Not to worry though, any unused capital losses can be rolled over to future years. So if you exceed that $3,000 in a given year, you can claim those losses down the line in the future, okay? You can reduce any amount of taxable capital gains as long as you have gross losses to offset them. let's say you had a $20,000 loss and a $16,000 gain, you can claim the max deduction, okay, of $3,000, and the remaining $1,000 loss will be used for your future taxes. So that's it seems like a good win there. So and that's it. That is my spiel about tax loss harvesting.